try to explain it. I want to say quickly, I mean, I've been doing this now. I've been with that work 13 and a half years. I can speak for myself that none of this is fake news. And I think I can pretty much speak for the network. None of it's fake news. I mean, we are reporting what's going on. Some of us have opinions. Reporters report. I just want to put that out there because I think it's important. I'm also not an economist. I'm not smart enough to be an economist, but I think I sort of understand what's going on. And I think history is littered with disastrous outcomes born of really good intentions. And I think we're seeing it now. I think in the 80s, Mr. Greenspan said, you know what, maybe we can take the recession out of the equation. And they were able to do that for a period of time. But I happen to think recessions are a natural part of the cycle. It's like the forest. Old trees burn down, new trees grow. It's unsightly, it's devastating, but it's essential. It's the same thing with our economy. And what does that mean? Well, I'll sort of tell you what it means. They put in place these things and people get lazy. How do they get lazy? Well, I think in many instances, corporate America got lazy. Give me an example, Guy. I'll give you two, and not to pick on either company, but I think General Electric got really lazy. I think IBM got really lazy. Why? Because they borrowed money cheap, they bought back stock, they paid their dividends, and off they went. Now they're coming home to roost. Everything's sort of coming home to roost now. I think, again, it's making people now focus on their businesses. What does it mean in terms of volatility? Well, for a long time, market participants bought options as protection. But when they saw the market just goes up every single day, they said to themselves, why bother? Why do I need to do this? It's just a cost I don't need. So they stopped. Then they said, well, wait a second. Maybe we can sell options. Instead of buying these things, instead of not doing anything, we could sell options. The market's never going to go down again. We'll create this synthetic dividend for ourselves, and everything will be fine. So whether they realized it or not, or intended it or not, the Federal Reserve and other central banks dampened volatility to a point that was unnatural. And I'll give you a really good example, and this plays into other things like passive investing. The weekend at Apple came out and said, you know what, things are going to be a little rough because of what was going on in China. That's fine. That's absolutely fine. Next day, the stock went, I think, from 322 down to 315 or so. Not a huge move at all. Next day, stocks trading right back at all-time highs. What does that mean? Market participants got lazy. And this passive investing looks past all the news. Now, again, we're seeing what the manifestations are. In terms of the option volatility, you're seeing what's happened when people have what I call, what market participants call, negative gamma. What happens is the lower the market goes, the more they have to sell, which exacerbates the downside, and the same thing happens to the upside. And we've seen it a number of times over the last couple weeks. The bad news is that doesn't get sorted out overnight. Unfortunately, it doesn't happen. This is 5, 6, 7 years worth of this going on that needs to be sorted out through the system. So that's what I think is going on. I'm not here to call a bottom. I'm not here to assuage concerns or stoke any investment fears or those types of things. I'm just trying to explain to you what's going on. And quickly, you know, the administration wanted lower oil prices and they wanted lower rates. Well, guess what? We got them. And look what's happening now. Last point, and we've said it on Fast Money now for a long time. I thought 1.4% in the 10-year was the point of diminishing marginal returns in terms of what it meant for the stock market. And look and see what happened when we went through 1.4%. See where we are now. Bond volatility, bond volatility is historic, and it's been going on for years, yet nobody talks about it. And currency volatility is historic, and it's been going on for years because nobody talks about it, because everybody's so equity-centric, and I understand that. But it's not healthy. And the last point, you tell me, go back to September, the Fed repo, when they said this is normal business as usual. There's absolutely nothing normal about what happened in September. And as we're now in March, what's going on now? They could say it's normal. That's fine. That's their prerogative. But if you look under the hood, something is really very wrong, and it's manifesting itself now. Sorry to take the last 5 minutes.
In just a quick word, because you manage money, what do investors do then? So all this being the case, it's still the market that we have. It's the market we have to live with.
What's funny is, so we're down 19, if my math is correct, Ty, I think we were just looking at this, we're down 19% from a historic high in the market. 19%. That's, you know, we've seen that before. The problem is we're seeing it in the course of a week and a half, and it's freaking people out. I mean, that's what happens when volatility gets tapered to the extent that it is. There's nothing normal about this, I get it, except that this is the new normal. And I'll say this, and quickly, Ty, and I know Steve is still here. He's going to absolutely disagree with me. I'm one of probably handful of people on the planet. October 2018-19, when Jerome Powell was saying, you know what, We're going to reduce this balance sheet. We're raising rates. I happen to think he was doing the right thing. You know, why follow everybody else down the rabbit hole of negative rates when you don't have to? If our economy was as strong as the administration said, there was no need to do that. And I think we'd be in a much better place now. I can't do the counterfactual. I totally get that, and I'm not trying to. It's just my opinion.
So the reason the volatility has gone away is largely what?
I think two things. Passive investing has dampened volatility, and central banks. I think, again,
central banks protecting us from
what are they protecting
ourselves.
us from? So what are they protecting? You know, in my opinion, the Federal Reserve's job is not to make the stock market go higher, right? It's not. I mean, I understand that they sort of need to. And again, this is just my opinion, but consumer optimism through the roof until recently. I think all consumer optimism is an overlay of the S&P 500. Not to suggest that everybody owns stocks. That's not my point. But when people see the stock market go up every day, year after year, they say to themselves, economy must be strong. If the economy's strong, I can go on that trip. I can buy that Starbucks coffee. And that's how 73% of that economy is exactly that. Go back to October 18 and November of 19 when the market went down 19.8% in a month and a half. Consumer spending stopped on a dime. And then they realized we have a real problem here. We can't normalize because it's going to upset the market. If it upsets the market, it's going to upset the consumer, and we have a problem. And that, I think, is what you're seeing now. Again, I'm not suggesting I'm right. It just happens to be my opinion.
All right. Guy, do you want to jump in, Steve? You have a